a litany of just this past month. Live real money trades, smashing it, precision, and it's no different from when I was showing you with a demo account. It's the same thing, it's the same logic. But if you have this premise in mind that you think the dollar's going to go higher, that means everything else should go lower, and you have your time window of 7 o'clock in the morning to 9 o'clock in the morning, New York local time. I'm not stating that that should be your time. I'm just using it as an example. I'm speaking hypothetically, okay? You can trade in the afternoon. You can trade the London session. I just don't think that you should be trying to trade the Asian session because there's not enough movement in there for me to feel confident to say, hey, look, spend your time and hope to be fruitful in that little bit of market action. It's not. Now, sometimes if there's a news driver that's coming out maybe in Asia, like an Asian market, like the Japanese yen, the Kiwi, the Australian dollar, because their markets are coming online. But the financial day doesn't really technically begin in Wellington. Okay, that's a misnomer. Sorry, Steve, you don't know what the fuck you're talking about. But the idea of this new day starting is New York midnight. That's where it all starts. That's where it starts. And technically, London is a carryover on the next day, where people will say, London is the real start of the day. It's not. It's just a carryover of what took place on the previous New York session. That's what these algorithms look at. That's how they refer to it. That's a real mechanism for referring to day-to-day transactions. But you're hearing things, and you see people in the industry that have titles. They come out there and they talk on CNBC, and because they're on TV, because they're wearing a suit and tie, because they have a title underneath their name and they work for some institution, when they say something, it's believed. But many times the shit that they say doesn't even happen. So I'm challenging you to think about things differently. And if you have a bias that you think the dollar's going to go higher, that means that your currency or currencies no more than two. What? Yeah, you're doing too many markets. You're diluting your attention because you think the more opportunities of finding a setup in more markets, because I did the same thing when I was 20 years old. I can't miss it if I'm looking at all these currencies. I got to have 28 pairs because I know eventually I'm going to find something in the chart. That's somebody that's just looking for any excuse to do something instead of knowing how to trade, waiting for the proper setup in a market that is going to, if you look at the euro dollar and the pound dollar, they're closely correlated instruments. Those pairs, those currencies are closely correlated. That means they usually, not always, but they usually move in tandem. They move the same direction usually. Not all the time, but most of the time. And that's advantageous. And it's usually diametrically opposed from what you see the dollar index do. Now, that's obviously market theory 101. Everybody should know that, but a lot of people don't when they first come. But if you filtered out the idea that you think dollar's higher or bullish and you want it to go higher, you're anticipating sell signals in euro dollar and you're anticipating sell signals in pound dollar. And then you can look at the relationships to short-term highs between the euro and pound. And when one of them fail to make a higher high, when the other will, that's an SMT divergence. So right away, what I've done is I've shown you how to think about things logically from a higher time frame, derive a bias where you're only going to operate with the premise that the dollar is going to go higher. And that means euro dollar and pound dollar are your tradable instruments. But you're not just simply using one and saying, I'm going to just focus on euro. That's foolish. You need to look at something that's closely correlated because you'll see a crack in that correlation when the euro and pound dollar. Let's go into euro dollar real quick. I always use forex.com. Not that that's a broker that you should use, but that's the data feed I always use. I've been using it ever since I started teaching it. And let's see. Let's drop into a 15-minute time frame on euro. Oh my goodness, he's talking about forex. Our focus and our premise for executions on euro dollar and pound dollar would be on the basis of selling short, looking for reasons to anticipate the market going lower. Okay, so when you're looking at euro, all of this is applicable to index futures too. So it's not like it's something different, because if we're looking at S&P, Notice that I'm always looking at what? I'm looking at least S&P and NASDAQ. I'm comparatively studying the relationships of its individual candlesticks delivery, its relative highs, its relative lows. How is it behaving? Is it moving in tandem, or is there a decoupling? A decoupling is when the market simply is not moving in a symmetrical manner where all assets are dropping as they should or moving up as they should. But there is an advantage in knowing and watching closely correlated markets or instruments, because it'll give you a telltale sign, like tipping its hand to you, saying, hey, pay attention to this, because this is a false move. And how do you know it's a false move? Because one of them are not moving to that higher high on a lower time frame. I'll kind of show you in a second, but give me a minute here to lay down some tent stakes here, because I want you to understand what I'm saying. And that way, when you hear me talk about, or you hear me or read me tweeting something to the effect that you have to have a setup that you cannot frame that would be opposing your weekly expectation. Said another way is, if you're bearish on the market that you're trying to trade and the dollar index is bullish, that in itself is the first ingredient, if you will, of a symmetrical market. That must be there. They must be diametrically opposed. If you can't see the marketplace through that lens initially, you are not in the first stage of high probability. That's just the way it is. I don't care who wrote books and made courses or whatnot. That's just the way it is. That in itself is not the entirety of your model. That's not how all of your trading should be based on. It just means that that's the first stage. Now, if it's not like that, if it's not diametrically opposed, does that mean you can't take any trades? No, it just means that you're probably best suited doing scalps intraday. And if it doesn't fit your appetite for trading, you simply have to sit on your hands and wait for the marketplace to present the opportunities where the dollar index is likely to move one direction, opposed to what you would expect in analysis in your euro dollar, pound dollar, whatever currency that has the dollar in its name as the secondary. If we have the expectation that the currencies or the currency that you're trying to trade is bearish, you do not want to be able to look at that and see something that would be bullish. If you can frame the idea that, yeah, I could see a buy signal, I could take a buy on that because of this, not impulsively, not because your elbow hurt the last time the euro dollar went up, so therefore now it's hurting today, you're going to try to buy it. That's nonsense. There has to be some kind of argument that can be framed logically as to why the market should go higher or lower. If you can be outlined through the mechanisms that you use for trading, if you can see both sides of the expression in terms of buying or selling short in the instrument that you like to track, you're not in high probability. So there's two ingredients right there for high probability trading. If you're an index trader and you think that obviously that we are in a risk off scenario, that means dollars higher, we have to anticipate the likelihood that rallies in indices are suspect. That means that they're not technically sound. They're going up there for a reason. What are they going up there for? To reprice to an inefficiency, or it's going up there to run buy stops. They're the only two reasons why markets go up. That's it. That's all there is, folks. There's nothing else going on. There's no animal patterns behind it. Wyckoff is not there. Supply and demand is not there. It's going up there to engage new sentiment, drag them in by their hair, or disrupt the present sentiment in the marketplace. And it's all based on liquidity, either creating the liquidity or removing it and unseating those individuals that are in the market and then taking their position over, so that way the market can then reprice for them, not you. It's rigged. And you can be mad about that. You can be scared about that and think, nobody can ever beat this. Nobody ever can be consistent with it. And that's rubbish, because you see my students all over the world now doing it. It's transferable knowledge. And the things that I'm teaching, people are seeing it and they can see it repeat over and over again. And as long as there's a marketplace, as long as trading is accessible to us, it will not ever stop working. So don't worry about it. If we can't trade, and then they cut the markets away from us and say, no, you can't trade this. And I can't imagine what starts that. But, in the event that it ever happened, whether it be temporary or, something else on a longer term basis, that would be the only thing that would cause me to say, okay, it's done. There's nothing we can do now. So it takes a Mad Max scenario for something like that, I believe. So I don't consider all that much or worry about it. But in the beginning, because you find this and you get excited about how the opportunities are presented to you, and you see them in your own chart, and you're thinking, wow, I could do this. I can put my own money in here and eventually grow it to this, or I can get a funded account and grow it to that, and I can make my ends meet. And all of a sudden you start thinking about what if it stops working? Well, what if it doesn't stop working? And all the time your energy you're wasting thinking about all that stuff is being drained. So you don't want setups that you can frame on both sides of the marketplace. So if you're bearish, it should be next to impossible for you to see any reason for it to go higher. No justification for it to go higher. No justification for it to pause. And when you trade in those conditions, that is a low resistance liquidity run. That means the market will move like a hot knife through butter. Just smooth, buttery. That is exactly what you want in your trades. You don't want to be in a trade that when you get in it, it's just spending a lot of time just hanging around your entry. If you look at the executions I share, they're like dynamic. Like when that execution's done, it spends very little time around where I entered and rarely ever moves towards my stop. Now, you've seen me. I've been stopped out and I went back in, did what I wanted to do, and re-engaged it. I executed that. It was live accounts, real money, and people tend to believe that those things don't exist here on this channel or on my Twitter. Like, I'm trading with real money, folks. I've taught for a long, long time in demo, but I'm about to depart from all of you in November on the 11th. And I promised you that you would see real money executions, and you're seeing it. The idea of you getting to the point of trading with real money, it's going to require you to do a lot of things that are in the beginning or feel very boring. But that's exactly what you want it to be. You want it to be boring. Your job pays you your wage when you go there and you do the job. You want your trading to be the same way. You don't want it to be an elevated and emotional, psychedelic event where you're tripping out on goofballs because you're either making a lot of money and you'd expect it to move that way, or you're losing a lot of money. 8:30, it's the news embargo lifting, so then you can see the displacement here lower.